Thank you guys for coming out to this. Thank you to the speakers. I'll have you guys introduce yourselves.
My name is Nate. I'm the founder of TokenDynamics, leading protocol design with an emphasis on value to token and economic security, which overlaps pretty heavily with risk ratings. We're constantly looking for those economic, financial vulnerabilities of DeFi rather than the technical ones. So we're speaking a little bit about that today, and I'll give it to the panelists to introduce themselves.
Yeah, thank you very much. My name is Carsten Hermann. I'm co-founder and CTO of Particula. We're doing risk ratings for digital assets, start with tokenized assets, and now also look vaults and pools. And I think the events of the past weeks were really remarkable, and you can see there's some kind of like risk and trust layer needed for the implementation of vaults.
Hey, I'm Charles from S&P 500, the credit rating agency. I lead all digital asset DeFi at S&P. We'll speak about risk, but I want to speak about all the things that I'm seeing from the vantage point globally that I have related to Vault. So it's going to be interesting.
Great. Yeah, and so I think while we're waiting for some of our other panelists to jump on here, we can lay a foundation for what we're talking about. I want to ask you guys how we define vaults. Like, are we talking about just 4626 ERC standard, or are we talking about vaults as a concept abstractly? How do you guys think about this?
So I would just take it and start with it. So I think for vaults, and maybe to also get some more understanding, how many people of you are like aware of the mechanics of vault or what a vault is? Maybe you can just give like a hand sign. Okay, a few ones. All right, thanks. So I think like a vault is basically like an on-chain investment product which is managed. It comes with much lower management fees. Of course, it introduces some new risks and so on. But I think the possibilities and to make it available for retail clients to leverage professionally managed investment funds, this is something I would think of when how to explain what a vault actually is and why I should use it. And I also think like looking a little bit ahead of time, there'll be so many products structured within like a vault structure, a vault vehicle, because it just takes away lots of complexity when it comes to professional investment products.
And I'll go next. Okay. So I'll make it easy. Vaults, and that's how it's presented right now to TradFi, are on-chain funds. So I guess if you're here, you probably heard of Vault, but that's the way it's presented to Wall Street right now. It's really Vault are on-chain fund. They are decks from Gauntlet where they're basically explaining to people that are not used to the field. A vault is a fund. A vault of vault is a fund of fund.
Great definitions for vaults. And if we could introduce the other panelists, Marcin and Sam, do you guys want to introduce yourselves, give a background?
Hey, I'm Sam, co-founder CEO of Phoenix Labs, working on Spark, and we're a big DeFi lending protocol. We do commercial lending within the Sky ecosystem.
Hi everyone, that's a loud one, sorry. Marcin over here, co-founder of RedStone and also Credora right now. We are the fastest growing blockchain oracle on the market, supporting over 180 clients, over 110 chains, protecting over $10 billion of asset, meaning that if we disappear, $10 billion is at risk, so it's pretty high liability. On the Credora side, we support DeFi risk ratings that are launching on Morpho and Spark, for example, to help users navigate the relationship between the risk and the yield opportunities that, for example, vaults are offering, so that we are not going to repeat to that extent situation that happened with stream finance or similar products that recently took a big hit and some people got hurt.
Marcin, do you want to recap stream finance for the audience?
Yeah. Who would call stream finance a stable coin? Raise your hand. Yeah, no one. But if I asked that question probably 4 weeks ago, there could be some that would say so. So some people believed that if they deposit money into Stream, they receive a receipt token, XUSD, that was deemed to be a stable coin, setting stable coin, which happened to be not so stable because it plummeted to 0, I believe, at the moment. Essentially, what was happening is an operator that was behind Stream was playing various strategies without much transparency or oversight. Once you were putting money into Stream, they would go on perps, they would go on other strategies and try to generate yield without much oversight over the risk that was associated with that. And what happened was at one point they just announced there was a hole of $92 million in assets, and the whole protocol went down and bankrupt. And the effects on the market were pretty devastating, especially for the vaults that hard-coded 1 as the price of that stablecoin. Because if you hard-code to 1, naturally you're not going to reflect that this actual stablecoin is not necessarily worth that much.
Yeah, I can comment a little bit on the stablecoin thing because, yeah, I think the term stablecoin gets thrown around a lot. But really, like, we should differentiate these things based on liquidity. To me, a stablecoin is something that is highly liquid, so you can depend on it to hold its peg, basically, no matter what. I would view, I mean, the stream finance thing aside, that was a whole different can of worms. But generally, I would say, like, lower liquidity lending, we should call it more lending and less stablecoin. Just like framing everything as a stablecoin is not a really particularly useful thing to do, and I think hides a lot of the complexities of lending in the back end. And so, yeah, there are particular things that are stablecoins and stream finance, and I would say most things are not stablecoins.
And Sam, not to put you on the spot too much, but you've been around for a long time in the space, and you've probably seen the evolution of vaults as a concept from ground zero. Can you describe that? Like, how have you seen vaults emerge, and what brought them about? Like, what do vaults enable, or what are the advantages of having a vault structure?
Yeah, I think it's mainly like the standardization that's come about over the years. People were having to invent everything from scratch, so usually this flow goes from, you build out what you want to build out, and you may decide to make a particular set of design decisions about the this is mostly on the technical side, like the smart contract interface, this kind of stuff. But then people kind of they find patterns that emerge, and the ERC 4626 standard is the vault standard now, and pretty much most major lending protocols use this now because it just allows you to plug in to different protocols much easier. So us at Spark, for example, this is mainly what we do, is plugging into other protocols. So we have our internal lending market, but also we'll deploy into Morpho, which supports the ERC 4626 standard. And yeah, this is really just standardization around interest-bearing. It's like an interest-bearing structure on top of an asset. So yeah, it's a pretty general thing. Traditional finance has interest, and so DeFi naturally has this too.
But maybe also to add to this, so looking back at maybe 4 or 5 years ago, how were vaults actually structured, and it was really simple. There was only one asset. I could just deposit some money. It was used like for lending and borrowing activities, and that's it. So what we are seeing right now, and what did really grow over the time, that on the one side, vaults became more sophisticated. So you have really like strategies in place. You can generate yield not only from lending and borrowing, but also due to staking, or even yield coming from the underlying assets where the money is being invested to. So it becomes more diverse in terms of like how it's yield generated. This is always also introducing new kind of risks, which I think we will tackle quite soon as well. But also I see vaults more becoming over the years institutionalized, more professional. We have now like really vetted custody players in place, a real like manager in between. And the whole setup of a vault is not anymore just, to say it fairly easy, a couple of people and a simple protocol. It's now becoming a really professional investment product. And I think like this evolution, what we have seen over the past 4 or 5 years, is really driving now also institutional capital into vaults. We are still like very much at the beginning, but the setting is now correct for that. So we now tick the boxes to make it really suitable for a professional audience. And looking back in the years like 2020, 2021, it was more like for the crypto digans, but not really like for a professional investment manager.
Yeah, professional.
If I can add on that. So
Yep.
there's been a huge switch. So vaults can mean different things, but in the context of the like of trader control vault, like more for like, in the last 14 months, we suddenly, like S&P, started to receive requests on, are you looking at the risk of vaults from fintechs, right? So you had custodians, you had staking provider, and the like. They were all trying to get the yield of DeFi and the yield you could get on chain to the customer. Then we saw that Coinbase and other Revolut, Excel that was on the news started to use DeFi protocol for their lend and borrow. But now in the last 6 months, all the commentaries, the question, etc., that we got were big asset manager. So now we have the biggest asset manager in the world, like the classic name you can imagine, but also the private credit shop, the biggest name you can imagine. And Christine Moy at the TAI event last week was saying that they're experimenting on Morpho. I think that eventually some of them, all of them, will be launching Vault. And I think it's going to be an IBIT/BDOL moment where you'll have some of the top leaders that will be announcing that now they're doing on-chain type of fund, the Vaults. And then all those that were not really looking at that, or were still behind looking at tokenizing a money market fund or doing whatever the other one did before, it's going to bring everybody to this kind of on-chain fund world. And why is the reason that they're interested? Well, all these asset managers, they always want to have more money in their products, so they see that as a way to get a new type of inflow of money. But also the next level is that they see that as a new way for mass customization of portfolio creation. Because when you start to have private credit on one side, everything that is being tokenized, royalty, Bitcoin, etc., with vaults, etc., you can create a portfolio in a very bespoke way, in a very customized way, much easily than you could even do it before.
Yeah, and I think it's also really, it's interesting that you mentioned this. I would also be curious to hear what those traditional finance players think about like the general standard or the general height of management fees in vaults. So I think for the user, it's quite interesting because you pay maybe, 0.2 or 0.5% management fee compared to like 2% in a traditional structure. But yeah, also maybe Charles, as you just mentioned this, what's the fear of those players? Like, why are they not doing it already on a massive scale? What are they waiting for? I think that's like a really interesting.
I think it's really new, right? So the fact that now, well, I'm telling you, and now you know too, that, well, those big names are looking at it. It takes time, right? BDOL was not created in 6 months or in 2. They always say like IBIT took 3 years or something like that. So I think they're all either experimenting or really highly thinking about it. They need, of course, to build around that. Some are working with the like of, the existing traders, some are doing it themselves. Of course, after the event of the last 2 weeks, some came back again saying, we really need risk assessment for vaults because, well, it's just for the service that the Particula and the S&P of the world serve. But just to see, and then I shut up, but another example of big traction that is in the field, there are conversation right now with real big insurance provider, and there is some insurance in DeFi. The problem is that they're useless because they're too expensive. And you're speaking about the fee, right? They're too high extra. But when you start to have like higher liquidity that come also from all those fintechs and the pool being filled by all those that want the yield, and because there was always a chicken and an egg problem, right? Like I've been in panel for 5 years almost now, and everybody, especially at post-FTX, they were saying, well, the problem is you don't have enough product in DeFi. That's why you don't have the liquidity, but you don't have enough liquidity. That's why people don't create product. Well, now you have the fintechs that bring liquidity, and you have the asset managers that want to take it and are creating product around it. It seems using vaults. So as they'll release, the fee will go down. And speaking of the insurance, as we have risk management they can trust and leverage, like they have in TradFi, then you'll start to see more traditional player bringing insurance, like there is already insurance for slashing rates and that kind of stuff. There could be insurance for collapse of some risk aspect of the vaults, and it's going to be a premium that makes sense, not what we have now.
I can add something to that. So yeah, I'll echo what Charles said. We see institutions that are very interested in DeFi and getting involved, but there's still some are comfortable, and it varies with different institutions. But yeah, one of the big missing pieces that I've seen is DeFi ratings. Is because there's been kind of even up until recently, there's just been this push to just get the highest yield possible, and this is like an unsustainable way to run things. We definitely need to be more cognizant of the risks that are involved with the various products that are being invested into, and this is a user safety thing. And again, the last 2 weeks have shown why it's not a good idea to have like sort of these like opaque funds that are just pulling money out and who knows what they're doing it with. You know, if you want to sign up for that, that's great, but there needs to be some level of checks in place, and it's on us really to put this in place, because if we have, if there are some sort of systematic risk that creeps into DeFi, we risk the whole system collapsing, and then that's not going to be good for anybody, because then the regulators are going to come in and basically forcibly get involved. It's better for us to get ahead of this and self-regulate ourselves so that people, I believe in user choice, but I believe in informed user choice. So providing as much transparency to the user so they know what they're getting involved in is you know, this is why I'm here. I think this is a fundamental improvement on the financial system, the transparency that the blockchain brings.
And before diving into maybe the risk management approaches and the ways that we can do risk ratings on chain and what that would involve, like what are the risks that we're talking about, if we can be a little more concrete? Because we've talked a lot about, you know, we've talked about some specific examples of stream finance blowing up in the last couple weeks, and there have been others. What are these high-level risks? Certainly Oracle risk, Marcin, and maybe some others that you have in mind.
Yeah, so 2 months ago, RedStone acquired Credora, which is the largest DeFi ratings platform. And an example, Particula, to my understanding, is doing an excellent job in rating like the assets themselves, for example, from Centrifuge and other like big players. S&P is bringing the traditional finance standard on-chain, like rating, for example, MakerDAO, which is one of the most OG protocols out there. And our role at Credora is to go into specific end strategies, for example, deploying into vaults or DeFi strategies managed by those vault curators. So talking about specific risk, in our quant model, we take plenty of inputs to define the risk, the rating from D to A. In example, we look into Oracle risk. So whether the Oracle in a vault is hard-coded, self-reported, delivered by the Oracle, and then if delivered by the Oracle, is it the market price, is it the proof of reserve, and so on and so forth. So there's like various flavors. Then when you have a vault, we look whether it's a vault with only 2 assets, like deposit and then allocate, or is it a vault of like plenty of assets and like some more sophisticated strategies? Is there rehypothecation taken into account? So in example, stream finance is probably on the scale, because risk is always a scale, right? Like you have from left to right. Stream was probably by any means like on the very much left side. Like they've been doing all the practices that were indicating that it can blow up at a certain point, and it did. For example, I'm not sure if you're familiar with the concept of Ouroboros, so essentially like a snake that is eating its own tail and just putting rehypothecated money into the same protocol so that the TVL is pushed up. And there's this very dangerous social proof idea in crypto that when a pool on a vault crosses a certain threshold, and to my informal chats with people is about $100 million. When someone sees a vault with $100 million in there, there is this kind of like chick-chack in the brain. Okay, others checked it, so I can put in another $50,000. It's not going to hurt anyone, right? Because the previous 100 million, those people had to do the due diligence. Well, they didn't, and this is what happened over there. Like, because as Sam pointed out very, very well, the vault curators are incentivized to put the highest yield, because so far the only metric that people were looking at was the yield. So the higher the yield, the better the vault, right? Well, there was no this other dynamic, which is risk. And this is what we are bringing right now to Morpho and Spark, so that people can look, for example, that the specific vault has 10% and an A-grade rating. And then the other vault is 20%, but has C+ or C, whatever. And then a toggle is going to inform the user what are the major metrics for the reason for such a rating. So in example, there can be lack of transparency. In Stream, that was one of the cases. So people were putting money in, and they had literally zero idea where the money is going, which is the other case for, in example, Ethereum. People put the money, and there is like 24-hour proof of reserves. Is Ethereum more dangerous than USDC? Of course, because it's like essentially tokenized hedge fund, right? Like, which you can call, for simplicity over here, synthetic dollar. So it is more dangerous, but if you're keeping to the standards that allow users to have verifiability and understanding the risk associated, this is also something that is needed for the general public. Another risk we were looking at, for example, is whether the protocol itself, in example, more for Spark, has at least 2 or 3 audits from reputable auditing companies, right? Again, if someone is going YOLO without auditing the contracts and, going without any necessary check from third parties, this is also a risk factor to consider. So as we move forward, I believe we as Credora at least will be playing this role of helping the general public to understand the segregation between the very high risk products, something that is in the middle like medium, and then something that is low risk. And we are a big proponent of low risk DeFi movement that was suggested by, for example, Vitalik a couple of weeks ago on Twitter, where people should not look for the highest yield for the short period of time that is the sexiest. They should rather allocate into the portfolio that is diversified and make sense over long term. Because it doesn't matter you're going to make 20% throughout 3 months and then the stablecoin depegs and it's worth 0 effectively.
Thanks. I think maybe to add to this, there's also some more dimensions to highlight. So when we talk about the vault and also a vault provider, in the end, it's also a team, it's a company behind it. And we also look at maybe the governance structure. So also to see how decisions are being made. Is there also a time lock in place? How fast are decisions becoming effective and so on? But also what you mentioned on the underlying assets where the money is actually invested in. We do really deeply assess all the risks involved, on the underlying asset level, token level, but also issue level, and especially when it comes to oracles. And I think we have seen it now. We have market oracles in some cases. We have fundamental oracles. That's a little bit where the problem started. That I have like you mentioned, a fixed defined exchange rate between the asset and investment. And there also we look, of course, also at RedStone, Chainlink, DIA data, PIF, and so on. And I think the Oracle structure is really remarkable when it comes to understand the risks involved in two vaults. Next to what you mentioned, proof of reserve, but also pricing, we also look at, for example, the NAV and also the shadow NAV to really understand, okay, what's the actual value on the market? How is it changing? And I think this would have been really helpful in the past couple of weeks if this would have been in place, that there's a deviation check. So I can also check information coming from two different oracles, maybe oracles that have a different approach, maybe centralized one, a decentralized one, also to understand what's the incentive for the data providers of the oracles, but then make a deviation check between those two values, but also between the actual movements of alternative or similar assets on the market. So to really have a benchmark, is this 30% drop in price really legit? What does it depend on? And not directly just take it into account and then proceed to normal operations. And I think also when it comes to the technical risk, and we have the operational risk, what we see is becoming more and more important is also that vaults in terms of their structures, what I mentioned earlier, become really ready for institutional deployment. And that's also where we have to pay attention to the legal and regulatory side. So it's a licensed custodian in place, whatever. So we really have to check that it's not only focused too much on the technical factors. I mean, for us in particular, of course, we're very much focused on technical risks, but also legal risk, regulatory risk, compliance risk. And this becomes increasingly important for vaults. And what we see in the market is there's still a lack of understanding when it comes to that. And maybe Charles, playing the ball to you, that would be really interesting for me also to hear what you think from a perspective of S&P about this general structure of vaults, how you see it right now in the market, and some of those risks I mentioned, which go away also from the technical side, more from compliance side, etc.
Yeah, so all the risk matters. So for some disclaimer, opinion on my own, and I'm not on the analytical side of S&P ratings. I'm a strategy at the overall S&P level. So in a credit rating agency, the analytical side is totally firewall. You cannot influence them in any way. That said, the way it works for classic TradFi ratings, you just look at every risk. So yes, of course, there'll be the smart contract type of risk specifically for this. There is the quality of the underlying, which is always very important. But then there's way more things. The track record of the creator, operational risk. When we see that PayPal minted, I think, 100 trillion of their token, it was because they made a typo on a form and they could not see it, and then they find out when people were
Those
calling.
Paxos, by the way.
Huh?
Not
It was
PayPal.
not PayPal. Sorry, PayPal. But the point is still the same, right? There is a lot of operational risk that should be looked at. It was not a major disaster, but kind of feel that it could have been. So yes, all type of risks need to be looked at. Now, my experience based on what was said before is that retail doesn't care about what risk assessors are saying. And we're not here anyway to say this is risky, you should not touch, and this is safe, you should touch. It's all about pricing the risk, right? It's about bringing visibility, and Sam was touching on that. You want to ideally have independent third parties that can review the risk, be expert at that, and then have this information so that, well, you can take more risk if the yield is higher, and well, then that's your choice. And the problem we have right now involves, but not only involves, like across DeFi, is like usually you know what the yield is, but you don't have any real visibility on risk. So yeah, I think everybody here is trying to address that. We do it in different way. In my mind, we're more all partners and competitors. Like what they can do, they'll do pretty fast. The rating of Sky took months. So it's different products having different needs.
Yeah, we need to have it automated and on-chain. Yeah, now I lost my point, what I wanted to say, but this was a really
you
good
just
catch.
made your point.
Yeah, okay, just got it. Because it was now mentioned 2 times, okay, we need to like de-risk vaults and have like low-risk vaults available for users and so on. But I think not everybody wants low risk and also low yield. So that's also why we work right now on like a structural yield index, where we create like a yield and risk profile for different asset classes. And therefore it's also possible to understand, okay, I want to go into an asset class that may come with a high risk, but also high yield, high return, and maybe create a basket of like low risk and high risk assets. And then I think the really crucial point is the management, like the risk operations, the risk management to really balance the portfolio, but get the most out of the assets available on the market. And that's why I'm not saying, okay, everything needs to be low risk, but we need to understand what's also like the return, the reward I can expect for that. And I think looking at past assurances, there were lots of products with very high risk and very low return opportunities. And I think then it becomes really uninteresting for the user.
So what are the best incentive structures for management for incentivizing and aligning the incentives of these curators, a term that we've not really talked about today, but the people that are overseeing the structure of the vaults and the strategies? What are the best structures that you've seen to incentivize these kinds of people?
To incentivize them to like want risk ratings?
Properly manage and assess what the risks are, and then be able to price them, to Charles' point.
Yeah, I mean, I can speak like what the incentives are. So us at Spark, we have Spark Savings, which we view as one of the best at scale risk-adjusted yields in the space. But how do you promote that, right? Like this is not the most sexy topic. Like everybody's excited about high yields and stuff like that. So I think there's this natural incentive for those who are trying to do a more conservative risk profile with the collateral to promote themselves and like fund these types of efforts like the risk ratings. And so this is why we're involved. And I think others who view themselves as doing a good job, not cutting corners, are also incentivized to do this. Yeah, but we've been doing risk ratings internally. You have to do it to underwrite any collateral that you're going into. Over the years, it's shifted. Primarily, it was, crypto collateral loans on-chain is still the primary source of revenue for Spark and USDS. And this is actually one of the better risk-adjusted yields, in my opinion. There's been no bad debt on any of the major assets within the Maker protocol since it began, basically. So this has proven to be a quite robust yield, and it's quite good, especially in bullish conditions. So for the underwriting of these assets, Maker was started in this realm of like mostly based on like liquidity, and you have to, depending on the asset, if it's ETH, that's like the most low risk asset on the Ethereum blockchain. But then you have to look at, if you're going into like a LST, like Lido, you have to look at the governance structure and how it all works. So this type of analysis we've done. What's more new is all the private credit stuff, and this is going to be where we get an explosion of different vaults and different providers, precisely because like I'm talking about at the scale of billions, there just wasn't that many opportunities like 3-4 years ago. It was basically just over-collateralized crypto lending, the CDPs. But yeah, now we just have a huge plethora of like options available, and it's going to it's going to become highly diversified set of risk curators. And yeah, but I mean, I think these guys already mentioned what the underwriting looks like more for like that. You're looking at like counterparty risk, you know, these types of things.
Yeah, so I highly recommend checking out our recent yield-bearing asset report. If you go to redstone.finance and check our blog post, it's the very recent one. Like we've done over a month research about every yield-bearing asset that is associated and what are the categories, what is interesting, what is the roughly yield. One point I wanted to touch upon over here is this kind of like a trade-off between automation and the speed and speed of delivery and then frequency of updates in a sense, right? Because the more manual the rating is, the harder it is to update that. And then the slower is the rollout. For us as Credora, we relaunched the product after the acquisition, I believe, 11 days ago. And it's already live on Morpho. It's going live on Spark. So two really strong partners who care about informing the users about the risk. I'm very proud to also announce that Euler has signed up. So we already have like 3 of the biggest lending markets in the DeFi space to utilize that standard. And I believe how to incentivize those operators to go into that is something that every of you knows from the high school. I believe all of you attended. It's called peer pressure. Essentially, the moment you create a standard and you point out fingers on people who don't want to get rated and the ones that get low rating because of the facts that are very well known, for example, lack of transparency or hard coding oracles that should not be hard coded. Because, by the way, like hard coding at Oracle is also like a very interesting aspect, right? Like, for example, I believe Spark sometimes does take that.
I can defend the hard coding, by the way.
Yeah, and that's what I'm saying. Like, it really depends on because sometimes using a market Oracle can be even worse because a simple wick can liquidate all the positions, and then you have a proper havoc. And we've seen it on the 10th of October when Binance reported USDE at 61 cents for just a moment and liquidated hell a lot of leverage positions out there, right? So it's some of the aspects in rating are obvious. So, for example, transparency, and some are conceptualized on the specific aspect. And for XUSD, hard coding one was definitely bad, right? Because it was like a synthetic stablecoin. It wasn't meant to keep PEG1 beyond any means. As we go forward with Credora, our core goal is that the users will demand those ratings. If they don't see a rating, they will be asking the protocol, hey, why aren't you rated? What is the reason for that? So that we create a standard, because it will help the discussion, because there is going to be also raising of the discussion. Hey, why is it a B and not A minus, for example? And then we have to, of course, defend our methodology, because digging into methodologies are very important. But we will create this kind of like expectation from the market to have more information for those kind of products, because so far it's been absolute Wild West. So we have to go into that direction to progress and essentially elevate the industry as the vault part.
Just want to comment quickly on the hard coding or not. I like, it's not like you should hard code or not hard code. It depends on the asset. So at Spark, we do use a lot of hard coded oracles because there's just not enough liquidity in DeFi and secondary markets to liquidate hundreds of millions in loans. And so you really, it's like not good to use the market price in some of these cases. Then you expose yourself to these temporary liquidity issues, and you may start liquidating positions, fire sailing them in like some sort of like brief liquidity event. So what I think like some of these oracles should maybe shift to is like where there's smoothing over temporary liquidity issues, but then you kind of want to switch to a market price if it's like sustained, because you want to protect yourself from permanent insolvency. So I think we're moving more towards these type of more sophisticated oracles, but things are kind of just progressing one step at a time.
Just one, quickly. I'm just thinking about what you were just saying before, and again, my experience is that retail tend to not care about risk. But so, for instance, for what you just said, if there was this kind of peer pressure on, the other are safer, so I need to be. Don't you think that, for instance, USDT is in a way a demonstration that retail really doesn't care about that? And the point is, they should, but where it's going to change is that now we have institutional DeFi institution coming in, and they care about risk assessment, and they are doing it themselves, and they want third-party opinion. But retail, when you see that USDT is the biggest by far, well, they don't have that peer pressure on, well, you should be more transparent.
Well, again, I'm going to come back to the scale. If we take the scale from 0 to 100 on the security, on the safeness of an asset, and 100 is a regular dollar, US dollar, and let's call it 99 is a T-bill, right? Because if T-bill goes down, our whole economy is screwed and no one knows what's going to happen. Then you can have a scale between the assets that are between 90 and 100, and then you have the discussion like, oh, is this tokenized asset via this provider better than the other one? But still we're talking about very low probabilities of default or like taking a big haircut. I'm talking more about the 0 to 900, like this scale is very large. And without ratings, many of the crypto users are taking something that is close to zero, let's call it XUSD, with, for example, USDS from MakerDAO that is also on the very right-hand side, and then Etina that is somewhere between those two probably, right? So just to give at least some understanding of what is absolutely hardcore risk and high yield. And it doesn't mean you cannot deploy over there. You can, but you should be just aware of that. And what you're talking about, I believe, is the nitty-gritties between the highest standard assets over there. And with USDT, yes, this is a big pickle for the industry, but I believe it's sustained so far. It's in a sense right now too big to fall. Like the moment it falls, we are going to have a big problem out there. But this is a question I believe where S&P is positioned to go after, right? Because I would assume S&P is going to produce less ratings, but for the most important aspects for the whole DeFi, whereas Credora is produce way more ratings for all the assets out there, so that when we have a new shiny thing and people put in $20 million, this peer pressure, this social proof mechanism is not going to allow another garbage asset to get so many depositors and so many people who could get hurt.
I think we can probably agree that retail doesn't care much about risk. I think that was a great understatement of the decade, Charles. But we have 1 minute left, and I would like to hear each of your thoughts on where vaults are going and what is the number one thing that will get us there. What's the number one thing that somebody needs to be building or that you guys are building that will get us from A to B?
All right, I will keep it short. So I think AI-enhanced vault management will come up big in the future. So it needs data and also maybe also like risk ratings to operate on this. Next to this, I think the whole complexity will be abstracted in a massive way. So for the user, it's just like, okay, I want to have like a safe yield of 5% with low risk. And I think also like the granularity of vaults within like a vault setup will increase a lot to also diversify risk more. So that's also one of the requirements, I would say. So that what we see right now, for example, the curator is also the guard within the vault. I think we need this additional possibility for circuit breakers. Maybe also in this example, like the Oracle providers, also like the risk provider, how will they rate it? Is there not like a conflict of interest? So I think this separation of roles will become more and more important.
Great. Marcin?
Two things. One is more efficient proof of reserves. So as RedStone, we deliver it ourselves. So we aggregate information about NAV and assets that are basically held in custodians for the protocol. But if it's more sophisticated, we also work with specialized providers such as Accountable. And then they are doing the reconciliation of the assets. And when we do the delivery and checking whether the wicks are not happening too much, like, for example, if the next update they give us is 30% haircut, is it actual glitch in their methodology or an asset did take that big of a loss? And the second thing is delivery of risk ratings from Credora, from Particula, from S&P, from anyone else on chain, so that you create circuit breakers and logic on chain that is dependent on some of those risk ratings, because so far it's more for the front end and for the discussion. There's not much automation happening with those risk ratings, but I do believe next to price, that is mainly used from the Oracle, rating and risk intelligence is something that is going to be utilized in DeFi and on-chain execution.
Yeah, I think you guys mentioned it, but I think it's important to reiterate that yes, retail, I don't think retail doesn't care about risk entirely, but yes, retail is pretty flexible with risk, I would say. And so there is the risk, systematic risk creeps in when you have this sort of obfuscation of the risks that are in vaults, and people tend to pile into things. And so my concern is not so much with if somebody individually is making maybe ill-informed decision, that's their prerogative. My concern is when this becomes a systematic risk for the entire ecosystem, because we cannot continue having, thankfully this cycle we haven't had like a Terra Luna type event, but those events are absolutely not good for the industry. And the best mechanism, while still enforcing or maintaining individual liberty, is to have risk ratings within the space. So just giving more information to the users, because the status quo is not sufficient.
So you'll have real liquidity coming soon. You'll have risk assessment. You'll have a very big name becoming trader. This will probably eventually lead to have consideration around regulation in the US, in the Clarity Bill or in the next one, which will then lead all the other countries to look at exactly the way they're doing with stablecoin.
Fantastic.
A hill I'm going to die on. Retail will care about risk ratings. Every time there's going to be a big blow up, people will wake up and look into them. And this is our job to make them take care of that. Because if we're just going to accept and say, oh, retail doesn't care about rating, this is like accepting status quo, and we are going to allow again and again such blow-ups to happen. So this is our job as the builders in the industry to reinforce that this is something important, and people like regular people who deposit money for a year and don't look at it. I'm not talking about ape traders that are doing perp 20x leverage. I'm talking about regular users that want to deposit into vaults. They should care about rating.
Yeah,
and then they buy meme
institutions.
coins.
Great. Thank you to the speakers. Round of applause.
Thank you.